Hello everyone, welcome to the Tim Booker channel. Wishing you an enjoyable time listening to books. Today, I'll be interpreting The Great Crash 1929 by the American economist John Kenneth Galbraith. This book, with just over 190 pages and less than 140,000 words, delves into a significant event in American economic history, the 1929 Wall Street stock market crash. The aftermath of this stock market crash directly triggered the global economic downturn, making it one of the most destructive financial events of the 20th century. After the severe blow to the U.S. stock market, it took almost 25 years to recover to pre-crash levels, finally reaching that point in 1954. It was in this year that Galbraith, now a Harvard University economics professor, decided to write a concise booklet reflecting on the details of the crash 25 years earlier, resulting in The Great Crash 1929. Interestingly, Galbraith didn't pour his heart and soul into writing this book. He chose the topic during breaks from academic research, spending about half a year compiling this slim volume. Surprisingly, The Great Crash 1929 became an immediate bestseller upon its release, selling over 100,000 copies in its first year. What's even more remarkable is that its popularity repeated every few years. In 1987, during another U.S. stock market crash, the book resurfaced on the bestseller lists. Following the 2008 financial crisis, the publisher, Harper & Brothers, received 12,000 new orders for The Great Crash 1929 within a few weeks. Since its initial publication in 1954, Galbraith's book has sold over 1 million copies, undergone 9 reprints, with the latest being in 2021. It has evolved from a phenomenal bestseller into a distinctive barometer for the American economy. Why has this casual book by a prominent economist gained such popularity? Galbraith provides an explanation himself. He asserts that the 1929 stock market crash resulted from financial speculation and a speculative mindset. However, most people in their daily lives are not particularly vigilant about their speculative tendencies. It often takes a crisis and subsequent losses for them to pick up a copy of The Great Crash 1929 and learn from the lessons of the past. This, according to Galbraith, is essentially a post hoc remedy. He emphasizes that during periods of rapid economic growth, people are most susceptible to losing their sense of risk and are easily propelled by optimism into investment traps. The stock disaster of 1929 occurred after nearly a decade of prosperity. Looking at later history, the 1987 U.S. stock disaster and the 2008 global financial crisis followed a similar pattern. Therefore, Galbraith hopes that everyone who reads The Great Crash 1929 will take it as a warning and calmly consider economic growth and personal investments. It's a timely reminder for us today. You might be wondering, does an economist writing about a stock disaster involve a lot of professional jargon, making it challenging to read? Not at all. Galbraith's The Great Crash 1929 is composed of a series of vivid characters and lively stories. In his narrative, confident bankers, risk-averse government officials, and ordinary people eager for wealth form a tableau, collectively shaping the American society on the eve of the stock market crash. When the disaster strikes, most people still harbor optimism, thinking they can escape unscathed, but the outcome is inevitably bleak. Through these stories of misguided optimism, Galbraith reconstructs the prelude to a financial crisis on psychological and societal levels, analyzing the causes behind these phenomena. His analysis still holds significant reference value today. Now, let's dive into the main content of the book in 2 parts. First, we'll explore the financial speculation phenomena and underlying reasons in American society on the eve of the 1929 crash. In the second part, I'll analyze why the efforts to rescue the market in the U.S. financial sector after the crash were unsuccessful and what warnings this stock disaster can provide for us today. Before delving into the content of this book, I'd like to share a story about a swindler. This swindler, a minor character in Galbraith's book, is still frequently mentioned today because of his name. His name is Charles Ponzi, an ostentatious Italian immigrant, and the Ponzi scheme is named after him. Regarding the Ponzi scheme, we now know that it relies on continuously attracting investors, using newly received funds to pay interest to old clients, creating a myth of high returns that is fundamentally unsustainable. Ponzi, employing this model, managed to defraud a staggering $20 million in 1920, equivalent to around $200 million today. However, his scheme was soon exposed, and he spent 5 years behind bars. Upon his release in 1925, Ponzi moved to the vacation destination of Florida in the southeastern United States and started a real estate company. Florida was experiencing a boom in the tourism industry at that time, with extensive construction taking place everywhere. Ponzi, boasting, claimed to have found a prime piece of land where building a resort hotel could yield a 400% return. However, lacking sufficient funds, he reluctantly divided the land into 23 parts and sought partners nationwide. Anyone willing to buy a 1/23 ownership share of the land could receive dividends within 2 months and even resell it for a profit. However, Ponzi's new venture collapsed rapidly. In the autumn of 1926, a hurricane destroyed nearly half of Florida's coastline, the tourist boom began to decline, and Ponzi could no longer pay dividends. At this point, shareholders finally decided to visit the site to see how their hotel was progressing. The truth was brutal. While Ponzi did acquire a piece of land, it was in a swampy area, neither near the sea nor attracting any visitors. The so-called hotel had not been built. Meanwhile, Ponzi himself had siphoned off millions from this scheme and had already squandered much of it. Although he was sentenced to another 7 years in prison, the shareholders could never recover their investments. During the entire Florida real estate bubble, over $100 million inexplicably evaporated. The collapse of the Florida real estate occurred in 1926, 3 years before the 1929 stock disaster. However, according to the author Galbraith, it already exhibited most of the characteristics of an economic bubble. First, investors knew almost nothing about the projects they were involved in. Ponzi's clients were mostly financial institutions and middle-class families on the east coast of the United States. They had never been to Florida, only saw a few promotional pictures, and decided to invest based on the skyrocketing local land prices. Galbraith argues that the farther investors are from the projects they participate in, the more they trust intermediaries like Ponzi, and the greater the risk of a collapse. Secondly, the investors brought in by Ponzi had no intention of building and operating hotels themselves. They merely wanted to be middlemen, selling their equity after the land price increased. Galbraith believes that the prices of Florida real estate were artificially inflated by these continuous speculators. As long as the number of speculators continued to increase, land prices would keep rising. Conversely, if the number of speculative buyers plummeted, the bubble would burst immediately. It had nothing to do with the real value of the assets. Now, the first question arises, why were there so many speculators in the United States at that time? This leads to a term called the Roaring Twenties. In simple terms, after the end of World War I, the United States experienced rapid growth in industrial economy, urbanization, and per capita income simultaneously. From 1920 to 1929, the total GDP of the United States expanded from less than $60 billion to $80 billion, averaging an annual increase of 5.5%. The income of the working class also increased by 11% each year. Many people could afford new toys like refrigerators, telephones, and private cars. It's hard to imagine that in 1929, the United States had over 20 million telephones, 40 million radios, and 26 million cars. On average, there was 1 car for every 5 people, a ratio 8 times higher than that of the United Kingdom at that time. The familiar Manhattan core area in New York was built during the Roaring Twenties. The iconic Empire State Building vividly reflects the prosperity of that era. During the Roaring Twenties, who were the idols of ordinary Americans? Galbraith mentions that they were entrepreneurs. Frederick Taylor, the founder of scientific management, and the car king, Henry Ford were heroes in the eyes of the American people. However, the most well-known figure was New York tycoon Roscoe Cobb. This fellow had several roles. He was the second in command at the DuPont Chemical Company, the vice president of General Motors, and the initiator of the Empire State Building project. What's more legendary is that Cobb started from scratch, achieved a position above 10,000 people through personal efforts, making his image even more positive. Cobb enjoyed being the center of attention and enthusiastically shared wealth creation experiences with ordinary people. In 1929, he wrote a famous article titled, "Everyone Should Be Rich." Pay attention, he said, should rather than might, speaking in a decisive tone. Cobb calculated the following: at that time, the average monthly income of the American working class was about $70. If someone saved $15 each month to buy stocks without spending the profits in the stock account and followed the wage growth rate and stock return rate of that time, after 20 years, this person would have $8,000 in savings and a monthly investment income of $400, enough for a luxurious life. If they felt the money was coming too slowly, they could also join a trust fund, take out a loan to buy stocks and bonds. In Cobb's view, his idea was simply to save the masses. Stocks have risks, investment requires caution, which is common knowledge for us today. However, in the Roaring Twenties, the annualized return rate of high-quality blue-chip stocks in the United States reached 11%, almost keeping pace with wage increases. Stimulated by such high returns, ordinary people had long discarded their risk awareness. Moreover, the entire American society at that time was pervaded by an atmosphere of advocating consumption and speculation. Near the landmark Columbus Circle in Manhattan, there was a neon sign billboard that read, "When you are 30, you should have $10,000 in assets, at 40, it should be $25,000, and at 50, $50,000. Advertisements in newspapers also constantly talked about the so-called modern lifestyle: you must have a new car, install a refrigerator in the kitchen, give your mother a mink coat for her birthday, and buy a diamond ring for your wife on your wedding anniversary. Such inflated desires were certainly not affordable by the steadily growing wage burden. Therefore, businesses took the opportunity to introduce installment payment services, and stockbrokers set up stalls on the streets to attract customers. Statistical data reveals that in the United States during the 1920s, over 60% of cars, furniture, and radios were sold through installment plans. Stockbrokers' counters even extended to university campuses and pharmacies. From 1923 to 1927, the face value of newly issued stocks in the U.S. inflated by 200%, with everyone striving for wealth. At that time, the historian Lewis Allen remarked, "From New York and San Francisco to the barren villages in the Midwest, even cobblers and bartenders were discussing the stock market." An ordinary blue-collar worker might have hundreds of shares of oil company stocks. The stock market had become a kind of religion for them, and those who couldn't get rich quickly even felt ashamed. If only ordinary people were enthusiastic about financial speculation, the danger might not have come so quickly. However, author Galbraith observed that even businesses themselves began to engage in the financial market, becoming the main force behind speculative activities. As mentioned earlier, during the Roaring Twenties, the United States experienced an economic peak. However, the market at that time was not like today, with a multitude of small businesses, startups, and industry giants coexisting. In the 1920s, the backbone of the U.S. economy consisted of a few leading companies. With the help of banks, they rapidly expanded nationwide, dominating most of the consumer market. In 1929, 50% of industrial and commercial wealth in the United States was concentrated in the hands of 200 large companies, most of which were publicly traded. The daily operations of these companies had detached from the realm of the real economy and become financialized. Figures like Roscoe Cobb, as mentioned earlier, who didn't understand chemistry or cars but could influence decisions at DuPont and General Motors due to financial expertise, were not uncommon. In the context of financialization, business owners gradually conceived a bold idea. Since the bull market seemed never-ending, instead of investing funds in the slow and lengthy process of expanding production, why not become lenders directly? Through stockbrokers, they could lend money to stock investors and make quick profits from their buying and selling activities. In other words, large enterprises were speculating with their own funds, artificially inflating their stock prices. Such practices are absolutely illegal today but surprisingly became a trend in the laxly regulated 1920s, as Galbraith warns. By this point, the stock market bubble was nearing the Florida real estate bubble of the past. Stock prices of companies had completely decoupled from their core business operations, becoming a pure numerical game. The continuous influx of ordinary people into the stock market provided the second condition for creating a bubble: speculators. A rapidly expanding yet fragile financial balloon was swiftly taking shape. You might wonder, what was the U.S. government doing? While profit motives were common for businesses and stock investors, the government should have taken on a regulatory role. Unfortunately, in the 1920s, the U.S. government adhered to a philosophy of laissez-faire and had no intention of intervening. The core figure in the political arena at that time was Treasury Secretary Andrew Mellon, after whom the renowned Carnegie Mellon University is named. Mellon himself came from a wealthy family and served as the Treasury Secretary for 11 years under 3 presidents, wielding considerable influence. His policy could be summarized in 3 words: tax cuts, spending cuts, and low interest rates. In Mellon's view, the U.S. economy relied entirely on businesses to drive it forward. Not only should the government refrain from meddling in business affairs, but it should also go to great lengths to create convenience for entrepreneurs, assisting them in financing and expansion. However, the beneficiaries of Mellon's support were not the real economy but large corporations and the banks behind them, making the situation worse. Under Mellon's influence, towards the end of the 1920s, the Federal Reserve repeatedly lowered the discount rates for commercial banks, facilitating the maneuvering of funds in the financial industry. As a result, commercial banks, having just obtained money from the central bank at a 3.5% low interest rate, immediately lent it to stockbrokers at a 12% interest rate, demonstrating a fearless attitude. Historian Lautenberg commented, "In those years, banks no longer looked like banks, they seemed more like salesmen for securities companies. They dared to sell anything to customers except car wheels." According to Galbraith's statistics, from 1921 to 1929, the scale of the real U.S. economy only expanded by 50%, but the money supply increased by 224%. Loans related to the stock market accounted for 10% of the broad money supply, a quite dangerous figure. Because each loan was connected to ordinary consumers downstream and securities companies, banks, and businesses upstream, affecting one part would have repercussions throughout the entire system. However, no one raised an alarm in advance. So, the above is a record from this book, depicting the financial speculation phenomenon in the United States on the eve of the 1929 stock disaster. In fact, by the time 1929 arrived, some discerning individuals had already realized that the economic prosperity in the United States was not as reliable as it appeared. The rising bad debt rate caused by excessive credit was becoming alarming. That summer, the U.S. Department of Commerce released several statistics. The national consumption growth rate plummeted from 7.4% in 1928 to 1.5%, housing construction investment contracted, and the accumulated value of unsold inventory reached $1.5 billion. These were typical, bearish signals. The Federal Reserve promptly reacted by raising the discount rate, hoping to limit the increase in new credit. However, this unexpectedly led to a new peak in financial speculation. By the end of August 1929, the total market value of all stocks on the New York Stock Exchange had inflated to $87 billion, and outstanding loans, yet to be repaid, reached a staggering $8.5 billion through brokers. This figure was dangerously close to the actual money in circulation, signaling a critical situation. On September 3, 1929, the Dow Jones Industrial Average reached its all-time high, and then lingered at this position for a month and a half. During this period, the number of new stock market entrants stopped increasing, and pessimistic news of adverse conditions circulated everywhere. The enchantment of the bull market seemed to vanish overnight. In late October, the stock prices of major corporations began to steadily decline, erasing the gains of the first half of the year within a matter of days. By October 24, the entire NYSE index dropped by 11% at the market opening. Subsequently, the automatic quotation machine gradually failed to keep up with the falling stock prices. Within half an hour, previously blue-chip stocks had no takers. 11 forced liquidation investors jumped off buildings on the spot, prompting the NYSE to urgently close the observation gallery on the top floor to prevent further incidents. This day is historically referred to as Black Thursday, marking the beginning of the 1929 stock disaster. It must be acknowledged that even after the onset of the stock disaster, U.S. financial giants contemplated efforts to support the market. At noon on October 24, an emergency meeting was held at the J.P. Morgan headquarters at 23 Wall Street. Attending the meeting were 6 heavyweight figures, including the chairman of National City Bank, Mitchell, the vice president of the NYSE, Whitney, and the executive director of Morgan Bank, Lamont. These magnates decided to collectively contribute $240 million, buying major blue-chip stocks at prices higher than real-time quotes, acting as white knights to maintain confidence. The details of this meeting were quickly leaked to the media to sustain market confidence. After this operation, by the close of that day, the decline in the Dow Jones Index temporarily halted. However, the market still appeared lifeless, and the exodus of investors continued. In 1929, the U.S. had not experienced a major stock disaster for a solid 22 years. Many people's experience with stock market crashes was still rooted in 1907, a crisis that was averted with the help of banking tycoons. Therefore, individuals like Mitchell, Whitney, and the previously mentioned Roscoe Cobb were confident that Black Thursday was merely an accident. With the entry of bullish forces, the downturn could be reversed. Coincidentally, on October 25 and 26, stock prices did return to a phase of small-scale fluctuations, without further drastic declines. Stockbrokers immediately emerged, doing their best to imply that it was the best time to build positions on the dip. Even U.S. President Hoover joined in to rescue the market. On October 25, he delivered a nationwide speech, publicly stating, "Our country's primary business activities, the production and distribution of commodities, are currently established on a solid and prosperous foundation." No concerns were evident. However, the peculiar aspect of the 1929 stock disaster was that the previous irrational surge was now unstoppable in its decline. After a brief market closure on the 27th, the plunge resumed on October 28. The Dow Jones Index recorded a record drop of 12.82%, with blue-chip stocks like General Electric, Westinghouse, and U.S. Steel almost forming a queue to decline. Before the market closed in the afternoon, bankers convened at Morgan's company once again. This time, they no longer had the confidence to maintain stock prices within a reasonable range. The conclusion of the meeting was hands off, in other words, doing nothing. The impact of this decision manifested just one day later. October 29 became the darkest day since the founding of the NYSE, known as Black Tuesday. The Dow Jones Index opened with an 11.73% drop, and in just the first half hour, 3 million shares of blue-chip stocks were sold. Everyone was selling stocks at any cost, with sellers outnumbering buyers by several hundred times. A darkly humorous incident occurred that day. A mail carrier delivering a letter to the NYSE, on a whim, randomly bought a stock for $1 per share just before the market closed, and the transaction was successful. At this stage, commercial rationality no longer existed, everyone's minds were focused on one thing: escape. The trading volume on Black Tuesday ultimately reached 16.41 million shares. Due to the astonishing speed of the decline, the NYSE's automatic quotation machine took 2.5 hours after the market closed to print the final prices for all stocks. The 50 major industrial stocks tracked by the New York Times averaged a 43% price drop, equivalent to erasing the gains of the past 12 months in a single day. The blue-chip stocks that financial magnates hoped to save just 5 days earlier suffered equally severe losses. General Motors' common stock market value shrunk by $2 billion in just 2 days. The total market loss amounted to $30 billion, roughly one-third of what existed before the stock disaster. Trust transactions and small exchanges tied to the stock market experienced even bleaker outcomes. Today's familiar Goldman Sachs, at the time, was involved in trust operations. Their flagship trust product, Blue Mountain, suffered an 87.5% drop in returns within a week, and the company's market value plummeted by a staggering 92%, almost facing bankruptcy on the spot. By November 1929, even bankers started panic-driven exits. Despite the Rockefeller family being called upon by the NYSE to announce that substantial market rescue funds would soon be available, it couldn't contain the continued spread of the stock disaster. More frighteningly, financial turmoil had already spread to the real economy, with major corporations starting to cut investments and expenses, leading to employee layoffs. Many American wage earners who had just lost their entire fortunes in the stock disaster were now pushed into dire straits. It took a full 4.5 years, until July 1933, for the 1929 stock disaster to truly come to an end. By that time, the total market value of all stocks on the NYSE was only 1/6 of what it was before the stock disaster. The entire $74 billion had evaporated, an amount equivalent to 3 times the U.S. military expenditure in World War I. According to the statistics of the author Galbraith, in the financial tsunami triggered by the 1929 stock disaster, over 4,000 banks and financial institutions in the United States went bankrupt, leading to the disappearance of $2.25 billion in deposits. Why did the previously effective remedy for market rescue completely fail in 1929? Galbraith conducted a thorough analysis. He found that at the time, U.S. stock investors could abuse the margin trading model, what we commonly refer to today as leverage. Investors only needed to pay 10% of the purchase amount, with the remaining 90% coming from loans issued by brokers, obtained at extremely high interest rates from banks. If stock prices continued to rise, all parties involved could profit. However, in the event of a sudden drop, investors not only lost their money but also dragged brokers and banks down with them. The bank's reserves had already been emptied beforehand, making it impossible to exert full force during the market rescue. However, the U.S. stockbrokers and banks were not innocent at the time, they were enablers of the speculative atmosphere. Later, when the U.S. Congress settled the score, it was discovered that Whitney, the vice president responsible for risk oversight at the NYSE, had been embezzling funds for an extended period, showing no concern for his responsibilities. Whitney was sentenced to 3.5 years in prison and permanently banned from engaging in securities trading. Other bankers also received varying degrees of punishment. However, margin trading was just a technical detail. Galbraith believed that the real issue was that the economic prosperity in the United States on the eve of the stock disaster had an unstable foundation, and the phenomenon of supply and demand imbalance was glaringly apparent. For example, from 1920 to 1928, the production capacity of industrial goods in the United States increased by 30%. This growth was partly due to reduced production costs and partly a result of optimistic sentiment. However, during the same period, the U.S. population only grew by 12%. In other words, even with installment payments and advertising, there weren't enough consumers to buy the goods on the market. Exporting goods overseas, like today, wasn't a feasible idea in the 1920s because of the high tariff and low export policies implemented by U.S. Treasury Secretary Mellon. The European market with purchasing power directly closed its doors to American goods. The strategy commonly seen today of driving growth through investment was not recognized by the government at that time. Consequently, businesses could only focus on consumers, hoping they would buy. What about the consumption capacity of ordinary Americans at that time? I can tell you a few numbers. In 1929, 71% of American households had an annual income below $2,500. Individuals with an annual income exceeding $10,000 accounted for only 2.3% of the total population. For most wage earners, buying cars and furniture on installment payments had already overdrafted their savings, making it impossible to increase consumption. Furthermore, the income gap between urban and rural areas in the United States was astonishing. Of the 123 million Americans at that time, only 15% lived in metropolitan areas like New York and Chicago. In rural areas, farm owners and farmers, affected by high tariff policies, couldn't find overseas customers. They could only sell wheat, cotton, and pork to large corporations at discounted prices, barely making ends meet. It can be said that the inherent malady of supply and demand imbalance in the capitalist system was escalating in the America of that time, serving as an early warning sign of the impending crisis. However, most people were completely unaware of the cliff ahead and were still sprinting towards the illusion of solidity and prosperity, until tragedy struck. Alright, that concludes the main content of Galbraith's The Great Crash 1929 that I've introduced to you. Originating from the US in 1929, the stock disaster eventually evolved into a global economic depression that had a far-reaching impact for over a decade. It is intricately connected to later historical events such as Roosevelt's New Deal and the outbreak of World War II. Due to the extensive influence and heavy toll of this stock disaster, it has become a recurring theme for economists and historians to delve into. Galbraith's The Great Crash 1929 is one of the most widely circulated works on this subject. Not only does it elucidate the causes of the outbreak of the stock disaster, but it vividly portrays the blind optimism and speculative psychology of Americans at that time. In reality, a stock disaster does not completely eliminate speculative tendencies. Whenever a crisis reoccurs, Galbraith's warnings are revisited. This can be considered a historical rhythm. For us ordinary people, Galbraith's little book not only unveils the complexity of economic activities but also sounds the alarm for risk awareness. Preemptive consumption and financial investment are present to varying degrees in everyone's daily lives, with their own rationale. However, if we lose a vigilant mindset and excessively indulge in consumerism and short-term gains, it may invite significant risks. When you find yourself indecisive on consumption and investment matters, consider opening The Great Crash 1929 and heed Galbraith's admonitions. So, that's the essence of this book. Congratulations on completing another book. Thanks to everyone for your support and attention. Please subscribe to the Tim Booker channel, like, and share this valuable knowledge with your friends. Let's combine wisdom with practicality to achieve our financial goals and create a better future together. Thank you all, goodbye.